This video is a crash course for young Aussies on index funds, what they are, why they're so great, what's available in Australia, and how you can get started using them. So index funds are just an investment product that's made up of a whole bunch of different stocks. So before we go any further, we need to understand the basics of stocks and the stock market. At its core, a stock is simply a tiny sliver of ownership in a company. If you buy stock in CommBank or Woolworths or Domino's Pizza, you are buying a really small share of ownership in those companies. And as a part owner, you are then entitled to a proportionately small share of all of the future profits that that company generates. If you own stocks in Domino's, every time someone orders a pizza, that company that you are now a part owner of makes, let's just say, 10 cents of profit, and you are entitled to a tiny little bit of that profit from every single pizza. Now, typically the companies won't pay that out to you. Sometimes they will pay a small amount every 3 or 6 months, and that's called a dividend. But most of the money they'll keep inside the company to continue to expand and operate and create new products. What actually happens is that as the company generates profit, the value of the company increases and your shares will increase in value proportionately as well. Of course, if the company loses money, then the value of your shares will decrease. Now, this is a big simplification of the stock market, and on a day-to-day basis, prices of stocks fluctuate for a whole variety of different reasons, the majority of which is simply random. But in the end, in the long run, that fundamental underlying truth is what will determine the growth rate of your stocks. Companies increase and decrease in value based on the amount of profit or losses that they generate. Now, the obvious next question is, well, which stocks should we buy? Which companies are going to make the most money over the next few decades? And that really is the trillion-dollar question. People have been trying to figure this out for the last 200 years, and the answer overwhelmingly is that nobody knows. There's heaps of research going back to the early 1900s that analyzes the long-term results of financial analysts' stock picks. This is people whose job it is to understand the market and analyze companies and pick and choose the winners out of the pack. And the evidence all shows that the majority of those people do worse than the market average. And that's just the professionals. Almost no non-professional investors, people like you and me, make more than the market average in the long run. And in fact, quite a few of us lose money over time. When I say market average, what I'm referring to is a stock market index. A stock market index is just a simple formula that takes most of the stocks in a particular country and adds them all together, and then tracks how that sum of companies increases and decreases over time. You've probably heard of some of these before. The ASX 200 is Australia's largest 200 companies. You've got the S&P 500, which is America's top 500 companies. You've got the Nikkei in Japan, the FTSE in Europe, the Hang Seng in Hong Kong. All of these indices kind of represent that country's overall corporate production and growth. And we can use them as a benchmark to compare against someone who's trying to individually pick and choose stocks. And like I said before, most people who pick and choose stocks do worse than the stock market index over the long run. Now, in the 80s, a couple of smart people realized the truth of it all, which is that the only winning move was not to play. Why try pick and choose stocks only to end up performing worse than the average? Why not just buy everything and become the average and get the same return as the index every year guaranteed? And that was the start of index funds. These people opened new investment companies that did exactly that. They just bought everything. And this ended up going really well for a couple of good reasons. The first is that it's incredibly easy. You don't really need to know very much about the underlying companies that you're investing in anymore because you're not constantly trying to assess whether they're good or bad. You just buy and hold everything, understanding that over time, the average rate of growth will be better than if you tried to individually pick and choose companies. The follow-on from this is that it makes these funds very cheap to run. Previously, we needed whole teams of analysts trying to scrutinize every little bit of information to decide whether these companies were worth buying or selling. And all of those people demanded very high salaries, which got taken out of the money that you invested as fees. An index fund basically has none of this. A single person can run a portfolio of billions of dollars because all they need to do is buy the right amount of each of the stocks every time new money comes in. The only downside was that to get started doing this required a lot of money because to accurately track the index, you had to buy everything all at once. And so for a long time in Australia in particular, these funds weren't very accessible for most average investors. And I think that's a big reason why you still don't hear very much about them from most older Aussies today. It wasn't really until 2010 that ETFs, or exchange traded funds, really took off. ETFs are simply a wrapper that takes that big pool of assets in the index fund and bundles it all into one single product and then splits it up into 1,000 little pieces that can be bought and sold on a stock exchange. And this is great because now you can really easily buy into these index funds using any online brokerage, and you can get started with as little as $100. So the last important question is, which index should you choose? Which country's companies should you invest in? And the answer is very similar to the same question about stocks, which is that nobody knows. Nobody knows which country is going to grow the most over the next 20, 30, 50 years. And so again, the answer is simply to buy the average, which in this case means buying all of the indices from all around the world. The good news is that this doesn't mean you have to go out and buy a bunch of different things from different countries. These days, we have new indices and ETFs that track all of the different regions in one. The gold standard for this is something called the MSCI All Country World Index. This is one index that tracks about 2,500 large and mid-sized companies from 47 different countries around the world. And over the last 35-ish years, it has increased in value an average 9% per year. And that includes a bunch of really big stock market crashes. The dot-com bubble in 2000, the great financial crisis in 2008, and the COVID crisis in 2020. Despite all of those, the average over that longer period of time is 9%. Now, it is very important to understand that investing in index funds is volatile. Just because the average is 9% does not mean that your portfolio is going to go up by 9% each year. More realistically, it's going to go up by more than that, by 10 or 12 or maybe even 20% in a really phenomenal year. But every so often, stock markets will crash and the value of your portfolio will go down by 20 or 30 or maybe even 50% very quickly, and you cannot predict when this is going to happen, and you should not try. It is incredibly important that you understand that this is a long-term investing strategy and that you are aiming for the long-term average return. Trying to time getting in and out of the market is just as futile as trying to pick individual stocks, and the research on this shows similar results. The vast majority of people who try to time getting in and out of the market end up doing worse than if they had just bought and held through it all. You should never be selling stocks because of what's happening in the markets. I'll go into more detail on this in another video, but basically your goal is to either never sell these stocks or to just sell them when you're retired, at which point you're not selling them because of what's happening in the markets. You're selling them because you need to turn them into income that you can spend. A good rule of thumb is that if you are saving money for something that's not retirement, and you think you're going to want to spend that money in less than 7 years' time, you probably shouldn't be investing that money into the stock market, even if you are using diversified index funds. Now, before we dive into how to actually invest in index funds, I do need to say that this isn't financial advice. You probably shouldn't just take this bar for bar and do it without a second thought. My goal is for this to be educational content based on what I wish someone had told me when I was 20, but with the products and services that are available today. And while I do think that it is a really good approach that will serve most young Australians really, really well, it may not be suitable for your financial position. So please do take the time to do some of your own research and make sure that it aligns with your financial goals. With that said, let's dive in and see how truly simple this is. The first thing that you're going to need is a brokerage account. This is the account that you'll use to buy and hold your index fund ETFs. And the main thing that we need to look out for here is brokerage fees. Most brokerage accounts will charge you a fee when you buy and sell stocks. If you're just getting started on your investing journey and you can only save, say, $100 a month, that's a great start. But if the broker is going to charge you a $10 fee every time you buy in, then you're going to lose 10% of your money up front, and that would be a really terrible deal. Now, fortunately, a couple of years ago, a new brokerage account opened up called BetaShares Direct, and it is awesome for a bunch of reasons. Firstly, they don't have any account fees, and they don't charge any brokerage at all on buying and selling the index fund ETFs that we're interested in investing in. Secondly, is they support fractional shares. This means that instead of being limited to buying a whole number of shares, which is a requirement on most other brokerages, on Beta Shares Direct, you can buy, say, 2.6 shares in the ETF, which is great because it lets you invest 100% of your money every time. And lastly is their auto invest feature. And this is the best part because it lets you completely set and forget your investments, which is ideal when it comes to index funds. The less that you need to look at this, the less likely that you are to have a change of heart or a panic and do something that's going to reduce your long-term returns. You can set up an automatic transfer from your bank account into your Beta Shares account each month, the day after you get paid, and then have that automatically invested into an ETF the following day without ever having to touch it. So now that you've got your brokerage account, the last piece of the puzzle is which index fund ETF should you buy? Like I said earlier, our goal is to buy an index fund that covers as many companies from as many countries around the world. Unfortunately, in 2025, Australia doesn't have a single ETF that tracks that all-world index that I was talking about earlier, but we do have the next best thing, and that is DHHF, the Beta Shares Diversified All Growth ETF. This ETF doesn't track one particular index. Instead, it's kind of a parent product that puts a couple of other ETFs together to make your life easy. About 37% is the ASX 200, that Australia's 200 biggest companies index, and the remaining 63% is made up of American and other overseas companies, big and small, from just about every country in the world. All up, it contains about 8,000 different companies, all of which you can become a part owner in if you buy this one single ETF. DHHF also has a very low management fee of 0.19% per annum. There are some other combinations of ETFs that you can choose to get a similar coverage of companies for very slightly lower fees. But like I said last video, simplicity is important. And if you are just getting started on your investment journey, only having to think about buying and holding one single ETF is going to make that much easier to get started and much easier to stay on track. Now, this ETF only opened up in 2020. And because stock markets have been doing particularly well since then, the average returns look really good, about 12% per year. Now, like I said earlier, at some point that you cannot predict, stock markets will crash and those averages will come down. But for a well-diversified index fund like this, it's pretty likely to return somewhere around 9% per year if you were to hold this for the next 30 years. So that's it. If you think that this is a suitable investment strategy for yourself, I really recommend setting up that Beta Shares Direct account, sending over $100 and putting it into DHHF so you can get a feel for how it works and how it moves around each day. And then if you're like me and you want to keep investing without having to think about it at all, I really recommend setting up that automatic transfer from your bank account to your Beta Shares account each month, and then using the auto invest feature to automatically put it into more DHHF each month as well. I hope that this video has given you a decent understanding of stocks and index funds and how you can get started investing in them. Please do remember that it's important to do your own research and make sure that this stuff is suitable for your financial situation. Make sure you check out my next video on superannuation. It is the most important video you can watch because it explains how you can set your super up to also invest in these index funds and massively amplify the returns in your super over the course of your life. I've also got a bunch of other videos on the channel about personal finance basics for young Aussies. So if you're interested, subscribe and check some of those out.